A nation recoils in horror, and the markets look the other way on hopes of a brighter tomorrow. This is Bloomberg Wall Street Week. I'm David Westin. This week, the former Secretary of Defense, Leon Panetta.
I think this is the time, frankly, not to threaten, not to bully, not to yell at each other, but to do some listening.
The chairman of the Securities Exchange Commission, Jay Clayton.
Our markets have transformed to a position where many opportunities are in the private markets.
Former Treasury Secretary Larry Summers.
I think we are taking substantial risks of a second wave of a reemergence.
Investment strategist Mona Mahajan of Allianz.
Given the momentum behind the health, the economy, and just the reopening broadly, I think we're going to see a little bit more buying.
Megan Greene of the Kennedy School.
This was the ECB being really bold and proactive, even if it's not as much as the Fed has done, for example.
And economist Jeffrey Sachs of Columbia.
When the dust settles, I'm afraid we're going to probably have the greatest increase of inequality that we've ever had in a short period of time.
Just when you thought it couldn't get any worse, it did. On top of a pandemic and a cratering economy, we faced a week of demonstrations and riots as people took to the streets to protest the brutal killing of a black man in Minneapolis. And President Trump, he said he would send in federal troops to quell the disturbances.
As we speak, I am dispatching thousands and thousands of heavily armed soldiers, military personnel, and law enforcement officers to stop the rioting, looting, vandalism, assaults, and the wanton destruction of property.
And as bad as the news was for the country, it was just that good for the markets as equities kept pushing higher, really reclaiming all of the ground they'd lost from the pandemic. And that wasn't all. At the very end of the week, we got extraordinary economic news as the United States created 2.5 million new jobs when people thought they were going to lose 7.5 million.
The numbers are great, and this leads us on to a long period of growth. We'll go back to having the greatest economy anywhere in the world, nothing close. And I think we're going to have a very good upcoming few months.
So if we needed it, this week gave us yet another example of the fact that the markets reflect part of the world, but not all of the world, leaving investors to hope that some of the problems in the real world don't spoil the party in the markets. And to talk about that party, we welcome now Mona Mahajan. She is investment strategist at Allianz. Mona, welcome to Wall Street Week. Good to have you here. Tell us about the party and specifically how important were those jobs numbers that we got just at the very end of this week?
Thanks so much for having me, David. Happy Friday, first of all. What a week. Look, the jobs numbers were incredible. I don't think anyone would have predicted a positive increase in employment, and yet we got plus 2.5 million versus the expectation of negative 7.5 million. Keep in mind the ADP numbers this Wednesday were also positive. They outperformed. We got plus 2 million versus an expectation of negative 7. So we had some indication of this, but clearly not to the extent that we saw today. And what's interesting is what was driving today's increase in jobs was actually the top sector to increase jobs was leisure and hospitality. And so this rotation that we've been seeing in the marketplace away from some of the COVID winners like technology and healthcare and into some of the more cyclical laggards, really, energy, industrials, parts of the financials complex, really kind of confirmed by today's news in the jobs report. And so, in our view, there's some technical factors that keep us really continuing this momentum towards the cyclical plays. Some of those factors include things like the amount of cash on the sidelines, both by institutional and retail investors, and also really the S&P itself crossing that 3,000 threshold last week. It was really a technical entry point and really a psychological entry point for many as well.
So, Mona, given what's gone on in the markets, which is truly extraordinary, where are the bargains left? I mean, are cyclicals basically fully priced at this point? Will that rotation continue, do you think?
Yeah, we think in the near term, we do continue to see the cyclicals outperform. There is some room to run when you look at the performance year to date. While they have had a tremendous about 3.5, 4 weeks now, we yet have to play catch up. The NASDAQ has hit an all-time high today. Tech is up about 8% year to date. And many of these cyclical sectors are still down 8, 15, even 20%. So we do see some catch up remaining. Of course, as we get through the next few months, we're going to be watching the mobility data, we're going to be watching the health data, and we're going to be watching the political data. I think all of those do factor in on the markets to some extent.
What about Main Street versus Wall Street, Mona? How did the small and mid caps do?
Yeah, absolutely. Look, this cyclical rally has been supportive broadly of small and mid caps versus large caps. And really, that's been the dichotomy in the marketplace. A lot of the big technology players are in the large cap space, and they happen to be COVID winners. Areas like cloud computing, cybersecurity, think about your complex around e-gaming, the video conferencing, even remote learning. Those tend to be larger, better balance sheet players. To your point about Main Street versus Wall Street, what's really interesting to point out broadly is that this crisis in particular happens to have hit really the mom and pop and really small businesses in this country. When we think about the S&P 500, for example, this is an index that has the 500 largest market cap players in the United States. They are better balance sheet players. They have more liquidity, and really they offer exposure to some of these winners that we talk about. So when we think about our investable universe globally, really, you can see why the S&P 500 and U.S. assets generally have been this flight to safety almost play in this crisis in particular. And so that's why we're seeing a continued momentum in the equity indices versus what we're really seeing on Main Street.
So Mona, trees don't go to the sky, in my experience. If you want to hedge a bet, where do you want to hedge?
Yeah, no, it's a great point. And, we've actually seen some of the more typical flight to safety plays like treasury bonds, like the dollar, like gold, all kind of trade sideways, even a little bit downward over this last 3 or 4 week period. What we would say is we continue to like gold here as an asset class. We think as central banks continue to lower rates and really offer more stimulus, gold tends to do well in that environment. We also continue to like parts of the investment grade market. The Fed has really come in and backstopped a lot of high quality investment grade in particular, which could be interesting here. What I'd also say is longer term, while the cyclical rally is ongoing currently, we do continue to feel like there are good secular growth themes that are not only, 1 year or 1 year horizon, but really 3, 5, 10 years out. And so when you do get those tactical opportunities to get back into some of your favorite long-term secular winners, particularly in tech or healthcare or biotech in particular, those are opportunities you should take advantage of if we see that over the next 2 or 3 quarters or so.
It's fascinating. What about value? Everybody says value is going to come back. Do you think it's coming back?
Yeah, look, value is about 25% of the S&P 500 index. And so there are a limited number of ways you can play this versus the broader index. And we're seeing a lot of crowding into the value space, which happens to be largely energy, financials, and parts of industrial. So very much overlap with this cyclical reopening story. That tends to happen, value does tend to do well as you're reemerging from a recession, which we've done almost in lightning speed, but we've done over this last few week period. And so I think that value play will continue to be a leader as long as the cyclical play lasts as well.
Mona, thank you so much. From Allianz, Mona Mahajan, great to have you with us. Coming up, we hear from the chairman of the SEC, Jay Clayton, about how the markets are working despite all the bad news and the volatility.
Markets reflect today's assessment of where we're going to be tomorrow. And I think the markets are looking down the road. They continue to anticipate a recovery.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The markets have been put through their paces this year so far, from a pandemic to an economic collapse to civil unrest. But through it all, the man responsible for overseeing those markets, SEC Chairman Jay Clayton, says that they have held up well.
What you're seeing in the markets today is you're seeing the markets look down the road as they always do. The markets reflect today's assessment of where we're going to be tomorrow. And I think the markets are looking down the road. They continue to anticipate a recovery. And that's what we're seeing in the marketplace today. And that's why maybe the markets are not moving as you might expect if they were looking at more current events.
If you look back over the last 2 or 3 months now, we've had a lot of market movement, a lot of volatility, precipitous drop in the stock index, come back a fair amount as well. Have the markets performed the way you would hope they would perform?
Well, yes. The answer to that is yes. Let me qualify that by saying performance being functioning. Now, again, I don't pick prices. I don't want to do that. Our job is to make sure that they're fair, efficient, that they're transparent, that people can make the judgments that make our markets work. And I've been very pleased from that kind of operational perspective. And I'd be remiss not to mention that the actions of the Federal Reserve, the Treasury, in conjunction with Congress and the administration, to provide certainty, to provide liquidity through the most challenging period so far, truly remarkable. If they haven't acted as quickly and as decisively as they had, I don't know that I'd be able to say that function has performed as I'd like. So a real hat tip to just across the government response to the uncertainty created by the pandemic.
Jay, if we go back to the very founding of your organization, 1933, 1934, it was founded on disclosure to investors, so investors could make informed decisions. The things that we need to know today to invest may be different than they were just even a year ago. Given this pandemic, issues of business continuity, of the way we treat our employees, does that change your attitude at the SEC about what needs to be disclosed, the level of it? How's the disclosure been on those sorts of issues?
David, you hit the nail on the head. It doesn't change the fundamental principles of our disclosure-based regime, which is companies should communicate with their investors the information that is material to make an investment decision. Now, what that is, depending on the environment and how it changes, may be different. And that's exactly what we've seen in the last earnings season. We're not seeing companies disclose, okay, here's where I was in January from an earnings per share point of view. Here are the few things that changed, and this is why you can expect a few cents more, a few cents less going forward. We're seeing disclosure around, okay, here's what happened to my operations. I'm able to operate in these areas like I used to. These areas are severely constrained. Here's what that means for my revenue. Here's what that means for my liquidity position. Here's how I've borrowed more money or raised more money in other ways. That kind of information is what investors are looking for. And you hit a very important one, which is operationally, when we have to be concerned about the health and safety of our employees, the health and safety of our customers, the health and safety of those around us. How does that affect our operations? And what more information do companies need about health and safety to better operate, to better serve their employees, to better serve their customers? All of that is new, but it does fit within our fundamental principles-based disclosure regime that I'm so thankful we have.
Talk about specific issues in relation to enforcement having to do with COVID-19, because there have been various reports of companies making claims that perhaps are unsubstantial and maybe misleading investors. Also, some reports that perhaps some public companies were not entirely truthful in applying for some of those PPP loans. What's the SEC status in enforcement of those sorts of issues?
David, we have let me put it this way, on the claims that look suspect or clearly speculative or just on their face fraudulent, our enforcement team is out there. They're shutting down trading in companies that would do that. And we need to be. People are counting on us to look at those kind of claims, quickly assess whether they have any validity, and then where appropriate, shut down trading so we can find out if tales of riches to come are in fact true. That's our job. I can't thank the women and men of the Enforcement Division enough for being vigilant in this area. I think the number of trading suspensions is into the 20s. I recently had a call with my international colleagues, and my international colleagues gave our Enforcement Division the gold star for quick action in identifying these types of scams and shutting them down.
Jay, let's turn to another subject that's very much in the news these days, and that is China. And you have been outspoken on one aspect of this, which is certain risks that American investors have investing in Chinese publicly traded companies. My question is, do you have the tools you need to protect American investors from those risks?
So, David, let's just articulate those risks fairly clearly, and then go to your second question. The principal difference between Chinese companies listed on U.S. exchanges and other foreign companies listed on U.S. exchanges is the ability of the PCAOB to inspect audit work papers of those companies.
Well, is disclosure enough in this situation as a practical matter? I mean, there are now proposals up on the Hill, as you know, the Senate has passed. It would say if a company, I think the rule is if you don't allow access to the audit papers for 3 consecutive years, you get delisted. Do you need that kind of power?
Well, first step, disclosure, but I do think that we need to consider whether more to level the playing field. And I think the bill you mentioned, the Kennedy Van Hollen bill, it's a very sensible way to look at this if you're going to do more, because it gives people a period of time to level the playing field before you would take any action. I'm not a guy who wants to take like precipitous, hit the nail on the head with the hammer tomorrow, but I like the way they've approached it in that there's a period of time to come into compliance, and if you don't, then it's time to take measures beyond just disclosure.
One of the things we talked about before is you're concerned that individual investors have access to some of the sophisticated sorts of securities that the big institutional investors have access to. How does that sit?
Well, continuing to work on that. It's an interesting, vexing, but important problem that we have to solve. Our markets have transformed to a position where many opportunities are in the private markets. And our sophisticated investors have the ability to tap those markets. And they do so with large investments. One of the great things about our public markets is individual investors invest side by side with our institutional investors. They get the same deal. If you invest in a public company as an individual investor, you're investing on virtually the same terms in all respects as an institutional investor. Challenge for the SEC is how do we get individual investors access to those private investments where they sit side by side with sophisticated investors and a pool of sophisticated investors. Great thing about public markets is you're not sitting just side by side with one sophisticated investor. It's a whole pool of them. How do we get people access to those private markets? They're sitting side by side with a pool of sophisticated investors and at a cost that makes sense, not a high entry fee or a high exit fee.
That was SEC Chairman Jay Clayton. Coming up, the ECB stepped up to the plate and sent its signal of continued support for the European economy. Harvard Kennedy School senior fellow Megan Greene is here to tell us whether it was needed and how much it will help.
This was more a signal that they're going to do whatever it takes, and that they're going to prevent fragmentation in the Eurozone.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It was the ECB's turn this week to step up to the plate and take a swing at supporting the European economy. And it increased its pandemic purchasing program by 600 billion euros, more than people had expected. We talked with economist Megan Greene of the Kennedy School about how significant this was.
This was the ECB being really bold and proactive, even if it's not as much as the Fed has done, for example. But for the ECB, this was a big move. It increased its bond purchasing, the PEP program, by more than expected. It also extended it by 6 months, and that wasn't expected. But it also announced that it would be reinvesting the bonds that were maturing over the course of the next couple of years till the end of 2022. And that piece is interesting because normally the ECB is somewhat beholden to its capital key. And the capital key is determined by the size of each country's economy. So the ECB can buy up bonds according to it, which means they mainly had to buy German bonds and then French bonds and then Italian bonds because the German economy is the biggest and the French and the Italian. And the ECB has been moving away from this capital key a bit already with the PEP. But the reinvestment program means that they can actually even things out according to the capital key by reinvesting the bonds that are rolling off. So they don't actually have to buy up bonds according to the capital key. They can kind of sort that out later over time through their reinvestments. And so it's a bigger step away from the capital key, which means they can step in and be more active in terms of buying up bonds for the countries that really need it. And I think that's probably the most important piece of what they announced.
So what was the urgency? Why did they need to do it? I mean, everyone expected it. I suppose there would have been a lot of disappointment if they had not done it. But what are the financial conditions like over in Europe? They'd already taken a fair amount of action back in March. Do they really need to really loosen up financial conditions more?
Well, they did. I mean, if you look at the economic data in Europe, broadly, it seems to be bottoming out and stabilizing. So we have found the bottom for most European countries. But based on the bond purchasing that the ECB has already done through this program, they were going to run out of money sometime this autumn. So they didn't actually have to announce more so soon. They could have waited longer. But again, this was more a signal that they're going to do whatever it takes and that, they're going to prevent fragmentation in the Eurozone. The German government just announced a huge fiscal stimulus program, which everyone's very impressed by. It's worth pointing out that Germany did this also back in 2009. And then the recovery fund that's still being debated among European capitals, I think it's that in conjunction with a bunch of other fiscal measures that might be changing sentiment for some investors.
So, Megan, that was actually my question about the fiscal. To what extent is there some relationship between what the ECB is doing and the possibility of fiscal, not just Germany, but also the 750 billion euro that's been talked about by Ms. von der Leyen? Are they really making it easier for governments over there to borrow money on the fiscal side by keeping the rates down, the costs down on the monetary side?
For most of the Eurozone and also for most of the developed world, borrowing costs are incredibly low, and that's the biggest role that central banks are actually playing. So that does help, but with the recovery fund in particular, they're looking at actually issuing AAA European securities, and so that will have its own borrowing costs, which should be really low given that it's European and given that the credit rating is so high. And so that should come with really low borrowing costs as well. And the important thing about that is that it's borrowed as debt, but it's given out as grants. It probably won't be a game changer for any of the countries that really need it. And Italy comes front and center. Yep. So Italy might get around 25 billion euros out of it. That won't be added on to its debt. And that's helpful. That's not a game changer for Italy, though. It's more important in terms of the political signal that it's sending, that actually Germany and some of the other northern European countries are agreeing to any kind of risk sharing at all and any kind of fiscal transfer. And it's not macroeconomically important this time, but it can be beefed up again in the next crisis. So it is a bit of an open door politically.
That was Megan Greene, Kennedy School Senior Fellow. Coming up, globalization and inequality, two topics much discussed this week. Economist Jeff Sachs of Columbia is here to talk about how they fit together.
What's happening, I think, is that we're seeing this dramatic wiping out of a large part of our economy.
This is Wall Street Week on Bloomberg.
Protests have swept the United States after the death of an unarmed black man and are highlighting racial disparities in America.
There is a brewing frustration among African Americans that they are not living the full extent of the American dream.
The unrest comes at a time when minority groups have been hit especially hard by the COVID-19 outbreak.
The pandemic is falling on those least able to bear its burdens. It is a great increaser of inequality.
Black Americans have died from the disease at a rate more than double that of any other race. Black workers have seen a higher unemployment rate than other races or ethnicities for decades, and the problem only got worse at the height of the pandemic.
The dispersion of income as a result of policies which have favored tax reductions has basically exacerbated the income equality issue. We need to cut up the pie again.
Almost 21% of black people in the United States live below the poverty level, a rate more than double that of white people. Access to quality education is a big part of breaking the cycle of long-term poverty.
There's been a demand for workers with greater skills, as you've seen more automation, and then we haven't met that demand by improving, education.
Building wealth through savings and investments is another factor in economic mobility. The median white family had a net worth 10 times that of median black families in 2016. The Fed's measures to support the economy could be widening the gap in the short term.
The Fed's monetary policy tools are really about supporting economic activity and driving the economy to higher levels of employment. However, that can actually cause financial asset values to go up, and that can actually exacerbate inequality.
We asked Columbia economist Jeffrey Sachs about the causes of this chronic inequality and what could be done about it.
What's happening, I think, is that we're seeing this dramatic wiping out of a large part of our economy, the brick and mortar sector. A huge amount is shifting online, and that is part of this digital trend that already has been leading to the concentration of income and wealth. When the dust settles, I'm afraid we're going to probably have the greatest increase of inequality that we've ever had in a short period of time.
Which is saying a good deal, because going into this, before the pandemic, we were not in great shape on inequality. It was growing to a substantial degree. There are remarkable statistics I know you've seen that, for example, back in 2016, 2017, the net worth of the median African-American family was 10% that of the median white family. So we had a problem going in. And then, as you point out, if you look at the COVID loss of jobs, it was greatly disproportionate on Hispanics and on blacks. What can we do to remedy that at this point? Because what we're seeing right now, I think, is certainly about police brutality, but it's about much more.
It's probably the case that when the calculations are made carefully, that the richest 20 Americans or so, all white, I believe to be the case, have more net worth than all the financial wealth of the African-American 40 million people in American society. I don't guarantee the number. I say this has to be looked at, but these are the relative orders of magnitude that we're talking about. The top billionaires, if you take the top 20, 30, have well over $1 trillion of net worth. Now, that's something like the financial wealth in the African-American community of 40 million people. What do we have to do about it? We have to become a decent society where everybody has access to health care. Everybody has access to education. You don't have a generation of students with $1.5 trillion of debt now completely unpayable because the prospects have worsened dramatically, but it was unpayable beforehand. And that requires companies like Amazon to pay some taxes, not to ask for tax breaks from around the country, but to pay their taxes. It requires the richest people to pay taxes. The Fed has, of course, issued trillions of dollars of new credits. But the way our system works, it's not credits for a broad society. It's credits that go through the already large concentrations of wealth and allow them to buy up even more of the assets on a fire sale basis. So easy Fed credits after 2008 was part of the increased concentration of wealth after 2008. Now we're seeing it again in 2020, that what the Fed's doing to keep the economy from collapsing is also going to have an effect on increasing the already almost unimaginable inequality of wealth.
And what is the solution for that? Because I suspect that's a law of unintended consequences. I don't think that Janet Yellen said in 2008, 2009, or I'm sorry, Ben Bernanke said, let's make sure that we have money sent to the people who already own a lot of capital. But they did decide they needed to do this to save us from a depression. We may be having a version of that right now, but an unintended, I suspect largely unintended consequence is If you inject a lot of liquidity in the marketplace, it sticks with the people who own capital. And by definition,
correct.
Those are the wealthy. What can be done about that? How can you save the entire economy and not benefit the richest?
Well, first of all, right now, like you say, you take emergency measures to stop the economy from going into a Great Depression, free fall. The most important thing to do, by the way, which is the one thing we're not doing effectively, is public health across our country to stop the spread of the virus. If we don't do that, no matter how many stimulus packages we have, we will not keep ahead of the epidemic itself. We're going to see very soon the horrific inequalities that have come from this worst crisis of modern history. Then I believe we're going to have to face that directly, heavily through a fair set of policies.
That was Professor Jeffrey Sachs of Columbia. Coming up, we ask Washington veteran, former Defense Secretary Leon Panetta, what the government needs to do to address a pandemic, a steep economic downturn, and civil unrest coming all at the same time.
The greatest trait of Americans is that we care for our community. We care for our community. I think we ought to take that value and apply it to each of these crises.
This is Wall Street Week on Bloomberg.
Racism is immoral. Theologically, it's a sin. Morally, it's wrong. We fight for justice and fairness. I am somebody. I am God's child.
For the first time in history, the United States faces a pandemic, an economic downturn, and civil unrest all at the same time. Leon Panetta faced his share of crises when he served in government, including as chief of staff to President Clinton when Jesse Jackson was giving those remarks on the Mall. He went on to serve as the director of the CIA and the Secretary of Defense, and his experience taught him how an administration deals with a series of crises that come all at the same time.
When facing a crisis and when facing a series of crises, as we are now, the best approach is to gather the National Security Council together and determine what the best strategy is to deal with each of these crises. And to develop options, obviously, to present to the president, but to try to develop at least a common strategy that everybody can support and that is in the best interest of the country in terms of dealing with that crisis. So I think this is a moment when the president needs to listen to the advice of his most experienced advisors. That's critically important at a time when you're facing this kind of serious threat to the country.
Is there any doubt that the president has the authority, the legal authority, to send in federal troops if he so chooses? There is this Insurrection Act.
Well, look, I think it's clear that the president could assert the Insurrection Act, but again, this country has recognized that the purpose of our military is to be trained to confront foreign adversaries in combat. Not to be used for riot control or law enforcement. The Posse Comitatus Act was passed in the 1800s for the purpose of making clear that the U.S. military ought not to take the place of law enforcement. And so for that reason, I commend the Secretary of Defense, Esper, for taking the position that he took, because military leaders, almost in unison, do not believe that our military ought to be used to fight our own people. It ought to be used to fight foreign enemies.
And finally, Mr. Secretary, give us a sense of the role that psychology plays in addressing any of these crises such as we have, because we have issues with respect to people feeling comfortable to go back out again, to go to restaurants, to go and gather again. How do we make sure that they feel safe? How do we make sure employees feel safe? And for that matter, how do we make sure that people living in cities where there are demonstrations feel safe? What is the president's role, the governor's role, in trying to restore our confidence in this society?
Well, that's the critical question that I think we're all confronting as a country. We're facing a unique set of circumstances between a pandemic that is uncertain in terms of its impact. It's already taken over 100,000 lives in our country, has shut down our economy and our jobs and our businesses. And at the same time, we have this racial issue which developed with this horrible situation with George Floyd and the knee that was placed on his neck, which I think created even greater concerns about our society and whether or not we're true to who we are as a people. I think this is the time, frankly, not to threaten, not to bully, not to yell at each other, but to do some listening to each other as to what the American people are confronting, and to understand that we really are in this together. I think de Tocqueville thought that the greatest strength in our country and the greatest trait of Americans is that we care for our community. We care for our community. I think we ought to take that value and apply it to each of these crises. We are in this together as Americans, and we have to work together. This isn't one side against the other side. The last thing we should do is to polarize this country at a time when we're facing these crises. The purpose, I think, of leadership in this country has to be to bring us together, to unify this country so that we all understand the importance of making sure not just that we preserve peace, but that we preserve the health of all Americans.
That was former Secretary of Defense Leon Panetta. Coming up, we wrap up the week with our special contributor, Larry Summers. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We wrap up our week with Harvard's Larry Summers, who, of course, was Secretary of the Treasury, and is our very own special contributor here on Wall Street Week. So, Larry, this has been a tumultuous week, I think it's fair to say. Every day we've seen the video of demonstrations and, yes, riots and, yes, looting across the country in response to that tragic incident in Minneapolis. At the same time, the equity markets just kept climbing higher and higher and higher. Why don't the markets pay any attention to the evening news?
Look, it's as extraordinary a week as I've ever seen. Someone said that we're living through the 1918 pandemic, the 1929 economic collapse, the 1968 civil unrest across America, and the Andrew Jackson presidency all at once. I haven't seen anything like it. And before we talk about markets, I think we have to acknowledge that the racial injustice that has been pointed up by the dramatic events now almost 2 weeks old is something that our country's been wrestling with for a long time and is going to be wrestling with for a very long time to come. What happened on the streets of Minneapolis just can't keep happening, and there's just been a huge outpouring of anger and upset. And a critical question for our democracy is going to be whether all of that anguish and anger is channeled constructively into positive change or doesn't bring about that kind of progress, in which case the cleavages in our society are only going to get worse. The market really doesn't seem like a very big thing relative to all of that. The market's job is to make a judgment about the profits that companies will earn, and in a proximate sense, as cosmically important as these events are, they probably don't change what those earnings are going to be over some interval. But I would caution that over long time periods, this kind of thing makes a very big difference. If you think back, the country almost unraveled in the late 1960s because of cleavages associated with the Vietnam War, because of strife over issues of racial justice, and not immediately. If you look at what happened to the level of stock prices relative to other prices, the real S&P 500, it had its worst long decade in the last 6 or 7 decades, in the decade that followed what happened in 1968. You saw a huge drop into 1974-5 with the Watergate episode, the oil shocks, all of that. And then you saw a further very steep decline into 1982. And so how America deals with all of this is going to be profoundly important, I believe, for America's health. And I don't think America's corporations can be healthy if America is not healthy. And I think enlightened business leaders have recognized that. And you've seen many, many CEOs making that point this week. So the markets are optimistic, and I hope the markets are right in their optimism about COVID. I hope the markets are right in their optimism about the society coming together. I'm not sure they are right. It seems to me there's a lot of optimism right now, and I worry that people who were very nervous 2 months ago are fearful of missing out. And it's that kind of FOMO that may be driving a fair amount of this market strength. If you think about almost all financial error, David, it comes from people doing today what they wish they had done yesterday. And everybody who is too scared to buy at the end of March regrets it. And there are a lot of people who think they're rectifying that error by buying now, and maybe they'll turn out to be right. But I'm not sure that's something that we can entirely count on. I think we've got a long way to go with respect to COVID, and an even longer way to go with respect to having a unified and, in a profound sense, functional society living to its potential.
So, Larry, if you want to talk about people being right and wrong, take a look at the people who were estimating the jobs numbers this week. They were wildly wrong by 10 million jobs. I mean, they thought they were going to lose 7.5 million in the United States. We actually gained 2.5 million. What do you make of that? How could that have happened? What does that tell us about where we're headed?
Look, it should give us, all of us who are involved in economic forecasting, a very great sense of humility. And obviously, it's a welcome development for 10 million American families and for America more generally. But I think it would be a mistake to overinterpret. We knew that the whole country was locked down in mid-April, late April, or even early May, in a way that was not going to be sustained. And so we knew that there was going to be a bounce back. We knew that businesses that employ millions of people had received grants, basically, but in order for those grants to be grants without an obligation to pay back, they had to rehire a large number of employees. So when I thought about these numbers as I did through the day, I asked myself, how much of this changed my view about where the economy would be at the end of the year? And how much of this, what represented an earlier bounce back from the floor than most people had expected? And I think it's more earlier bounce than it is stronger and bigger bounce. So it's certainly good news. But when the president starts talking about how it's going to be faster than a V and the economy is going to be a rocket ship and all of that, maybe no one can know for sure. But the fundamental constraints on the economy, some sectors aren't going to be able to come back as long as COVID is pervasive. There's a risk of a second wave of COVID. There's substantial financial overexposure and leverage, and especially in the real estate sector where tenants aren't paying and landlords aren't in positions to pay mortgages, and that's putting strain on the financial system. Those problems aren't resolved, and they're not really closer to being resolved because we got a good employment report today. So yes, faster bounce, but I'm not sure the ultimate place we get is going to be very different.
And finally, Larry, we need to spend 1 minute here at the end to connect those 2 points up, which is the striking thing to me of these numbers was the unemployment for Black Americans actually went up as it went down for both whites and Hispanics. What causes that?
It's the old adage, David, I suspect, last hired, first fired. And in this case, it's first fired, last hired. And that's what we're seeing. I don't know whether we can reach a firm interpretation on the basis of 1 month's numbers, but God knows it's not right that African Americans are doing as much delivering as they're doing and as little being delivered to as is taking place. And that's got something to do with the patterns that we are seeing, and we're going to need to do something about that, and we're going to need to address these questions of inclusion if we're going to have the kind of economy that we all want.
Yeah, and of all the weeks for that to happen, this was not the one to have it happen. That's so true, Larry. There are larger issues here that we're going to have to come back and address again and again. Many thanks to our special contributor, Larry Summers of Harvard, former Secretary of the Treasury. That does it for Wall Street Week. I'm David Westin. This is Bloomberg, and we hope we see you next week.